Hello everyone, welcome to the discussion session on income tax. I am Dr. G Selvalakshmi, Assistant Professor of Commerce, Sri Sharada College for Women, Salem. Today we discuss about the income tax. Generally, taxes play an important role in the economic development of the country. The government collects the tax from the public and spend it on welfare expenditure to the people, for example, laying roads, bridges, healthcare facilities, constructing educational institutions, etc. Normally, Indian taxation structure is of two types, that is direct tax and indirect taxes. Income tax come under the category of direct taxes. In this direct tax, we particularly discuss about the heads capital gain. Already we know totally the income is divided under 5 categories as per the Income Tax Act. First one is income under the head salary, then income under the head house property, and income raised from business or profession, then income from capital gain and any other sources of income. Out of these 5 heads, the income from capital gain is the fourth head of tax. As per the Income Tax Act, the capital gain is specified under section 45. Any profits or gains arising from the transfer of capital assets that transfer is made during the previous year is chargeable to tax under the head capital gains. The taxation of capital gains depends on two aspects, that is capital assets and transfer. So the capital asset means before going to discuss about the capital asset, we must know the essential conditions for taxing the capital gains. While calculating the tax for capital gains, the asset must be a capital asset. It is very important. And at the same time, the capital asset must have been transferred during the financial year itself. Then the profits or gain arise from that transfer only. These are all the essential conditions for taxing the capital gain. In this topic, we discuss there must be a capital asset. While calculating the capital gain, the asset must be a capital asset. But some assets are not included in capital asset. That is, some of the assets are excluded from the capital. These assets are that is any stock in trade, consumable stores or raw materials held by any assessee for the purpose of doing his business or profession. And at the same time, the movable property, for example, refrigerator, furnitures, motor car and electrical appliances are excluded from the capital asset. Then agricultural land, the land is situated in rural India, is also excluded. And the bonds or some bonds are not included in capital asset. That is 6% gold bond 1977, then 7% gold bond 1980, then National Defense Gold Bond, Special Bearer Bonds 1991, then Gold Deposit Bonds issued under Gold Deposit Scheme 1990. So these are the assets or excluded from the capital assets. At the same time, we must know the meaning of capital assets. So capital asset means any kind of property, that is the whether the property fixed or circulating or movable asset or immovable or tangible or intangible, which is held by an assessee, including the property of his business or profession, the capital asset, and also include the goodwill, leasehold rights, jewelry, shares and manufacturing licenses, etc. So these are all the assets are called capital assets. Further, the capital assets are divided into two types. One is short-term capital asset and another one is long-term capital asset. The short-term capital asset means the asset which is held by an assessee is not exceeding 36 months immediately preceding the date of his transfer. And however, some assets are qualify for short-term capital assets if it is held not more than 12 months. For example, equity preference shares held in a company or any other security listed on a recognized stock exchanges of India and units of a specific mutual funds. So these are all the capital assets is considered as short term for not more than 12 months. The assessee which is held up to 12 months, it is short term. If exceed the 12 months or exceed 36 months, it is called long term capital asset. And at the same time, the criteria of 36 months have been reduced to 24 months for immovable properties only, such as land, building, and the house properties, which is effected from the financial year 2017 to 18. For example, if you sell house property after holding it for a period of 24 months, so any income is arising from the house property will be treated as long-term capital gain, provided that the property is sold after 31st March 2017. Then long-term capital assets. An asset is held for more than 36 months is a long-term capital asset. The reduced period of the aforementioned, I told no already, the 24 months from the 36 months to reduce to 24 months is not applicable to movable property. That is such as jewelry, debt-oriented mutual funds, etc. It is not applicable. It is only for immobile property only. So some of the assets are considered as short-term capital assets when these are held for 12 months or less. Some rules already we discussed, that is equity or preference shares listed by the recognized stock exchanges or units of UTI, mutual funds, zero coupon bonds. These are all treated as a short-term capital asset. These assets which is held by an assessee is less than 12 months means treated as short-term, or otherwise it is considered as long-term capital asset. Then we talk about the term transfer. So meaning itself I told the capital gain depends upon the two aspects. One is capital asset and another one is transfer. Now we discussed capital asset is short term and long term. The types of capital assets we discussed now. Then transfer. As per the Income Tax Act, Section 2, subsection 47, discuss the term transfer in relation to the capital assets. It includes the sale or exchange of the assets. Suppose the compulsory acquisitions thereof under any law, it's come under the category of transfer. Compulsory acquisition means for any purpose, for newly set up of industrial undertakings or existing industries or go for renovations, the government needs some space or government needs some land or a building or anything, that is compulsory acquisitions from the assessee to the government. In case where the asset is converted by the owner thereof into and treated by him as stock in trade of a business carried on by him, such conversion or treatment is called transfer. The transactions involving the allowing of the possession of any immovable property to be taken or retained in part performance of the contract of the nature referred to the section 53A of the Transfer of Property Act 1882. And at the same time, any transactions whether by way of becoming a member or acquiring shares or a cooperative society or company or other association of persons, and by way of any agreement or any arrangements or any other manner or whatsoever so which has effect of transferring or enabling the enjoyment of any immobile property is called transfer. Then how would we calculate the capital gain? We have to follow some methods while computing the capital gains. Usually the capital gains depends on the types of capital assets transferred. For example, short-term capital asset or long-term capital asset. The gains or profits arising from the transfer of short-term capital asset is called short-term capital gain. Likewise, the transfer of long-term capital asset, any gain or arised from the transfer of long-term capital asset is called long-term capital gain. While calculating the short-term capital gain, we considered some deductions from the full value of considerations. The full sale value of consideration, for example, the sale value of the asset is, for example, we consider it as a 10 lakhs. The full value of consideration is 10 lakhs. From this consideration, we have to deduct the expenses relating to the transfer of assets from the assessee to another person. The expenses is deducted from full consideration, then we get net sale consideration. From this net sale consideration, again we have to deduct the cost of acquisition and the cost of improvement. So what is the meaning of cost of acquisition? Means the value of the purchase of assets. When the assessee purchased in first time, that value is called cost of acquisition. Then cost of improvement means the cost of improvement is the capital expenditure which is incurred by an assessee for making any addition in the capital asset or making any improvement in the capital asset is called cost of improvement. After making these deductions, that is cost of acquisition and cost of improvement is deducted from the net sale consideration, then we get short-term capital gain. From this short-term capital gain, some tax exemption is specified under the Income Tax Act. Section 54B, Section 54D and Section 54G is considered as exempted from short-term capital gain. Further we discuss the exemptions. Now we discuss about the procedure for computation of long-term capital gain. Long-term capital gain is also computed by deducting from the full value of consideration arising out of a long-term capital assets. The following items are also excluded, that is deducted from the long-term capital gain. Here also first we considered full value of sale consideration. From this consideration we have to deduct the expenses relating to the transfer of that capital asset. Maybe it's a brokerage or commission or a scrap or anything. The expenses relating to the transfer of the sale of asset is deducted from the sale consideration. Then we get net sale consideration. From the net sale consideration, we have to deduct indexed cost of acquisition and indexed cost of improvement. Then only we get long-term capital gain. The indexed cost of acquisition means an amount which bears to the cost of acquisition the same proportion as cost inflation index for the year in which the asset is transferred bears to the cost inflation index for the first year in which the assets was held by the assessee or for the year beginning on the first day of the April. So in 2001, whichever is later is considered the index cost of acquisition. Then indexed cost of any improvement. It means an amount which bears to the cost of improvement the same proportions as cost inflation index for the year in which the asset is transferred bear to the cost inflation index for the year. So which the improvement to the asset took places. That is indexed cost of improvement. So then what is cost inflation index? In relation to the previous years, the cost inflation index means Such index as the central government may have regard to 75% of average rise in the consumer price index for urban non-manual employees for the immediately preceding the previous year to such previous years. It is notified in the official gazette also. After these two deductions from net sale consideration, we get long-term capital gain. From this long-term capital gain, we deduct some exemptions specified under the Income Tax Act. For long-term capital gain, some of the exemptions are given, that is section 54, 54B, 54D and 54EC, 54F, 54G and 54GA. After deducting these exemptions, finally we get the taxable long-term capital gain. Now we move on to the exemption of short-term capital gain, that is 54B. The transfer should be of agricultural land, that is the capital asset is transferred from one assessee to another. The asset is considered as, that asset should be a agricultural land. That gain is reinvested in purchase of another agricultural land within a period of 2 years after the date of transfer. Then it will be considered as exemption from tax. At the same time, the 54D also considered as exempted from capital gain, which is the industrial undertaking. That is, the asset must have been used in the 2 years immediately preceding the date of transfer of assessee for the purpose of the business of undertaking. The property is compulsorily acquired. It should be a land or building or forming part of on industrial undertaking purposes only. So within a period of 3 years after the date of compulsory acquisitions of any other land or building should be purchased, then it should be considered as exempted from tax. Then 54G is also considered as exemption. The transfer should be due to shifting to any area other than the urban areas. That is the machinery, plant, building, land used for the business of an industrial undertaking. It is situated in urban area. It should have been transferred to other than the urban area. Again be installed in other than the urban area. Then it is considered as, that is the cost of the new assets or the expenses incurred for shifting is the greater than the capital gain, means the whole of such capital gain is exempted. Then the exemptions regarding long-term capital gain. Section 54, some of the conditions to be satisfied, then only the exemptions will applicable. The transfer should be of a residential house, the income of which is chargeable under the head income from house property. It must be a long-term capital asset. That gain is reinvested to purchase of another residential house property only. Also within the 1 year before or 2 years after the date of transfer. Then only it will be considered and allowed for deductions of the assessee. Then 54B is also already discussed, but here also the same rule, it must be a long-term capital asset. Then 54D also the same. 54D already discussed in short term, whether it is considered held by an assessee for below 36 months, it will be exempted under short term gain. In case it is a long term means, then it is considered for long term capital asset deductions. Then 54EC, the assets transferred should be a long term capital assets here also. Then within a period of 6 months after the date of transfer, the capital gain must be invested in a specified assets. Specified assets means, as per the Income Tax Act under section 54EC, they specified some bonds redeemable after the 3 years issued by National Highway Authority of India or Rural Electrification Corporation Limited. the actual amount invested in new assets or the capital gain, whichever is less, is considered as exemption. But one thing we must keep in our mind while calculating the exemption, the invested in any financial year, the maximum amount cannot exceed 50 lakhs. We should consider that point. Then another exemption is 54F. Here also the same rule. The asset transferred should be a long-term capital asset. And one thing here, it's not being a residential house. The asset is not a residential house. The asset is a residential house. Then come under the category of section of 54. 54F is not a residential house. That is, other than the residential house, the capital asset is transferred from one assessee to another within a period of 1 year before and 2 years after the date of transfer, and that gain is reinvested in the residential house, should be purchased or constructed within a period of 3 years after the date of transfer. It is considered as exemption under section 54F. That is, the gain arised other than residential house, but the gain amount is reinvested in the residential house, whether construction or purchase, in whatever it is. It is considered for exemption under section 54F. And 54G already we discussed, that is the machinery, plant, building, it is transferred, that is other than the urban area. So it is held for less than 36 months, means it is treated as short term, or otherwise it is considered as a long term capital gain. Then 54GA. The 54GA is considered as the assets transferred from the urban area to special economic zone. The amount so invested in that area is considered as exemption under section 54GA. So these are all the exemptions under capital gain. Apart from this, some exemptions also specified under section 10 subsections 1. That is the section 10 and subsection 14 is considered as exemption. Then in that particular exemptions, some subdivisions are also there. Section 10 subsection 33 specify the long term or short term capital gain arising on transfer of units of unit scheme 1964 is exempted. At the same time, an individual or Hindu undivided family can claim exemption in respect of capital gain arising on transfer of agricultural land situated in the urban area by way of compulsory acquisitions. It is also considered as exemption under section 10 subsection 37. Then section 10 subsection 38 also provide some exemption. The transfer of equity shares or units of equity oriented mutual funds or a unit of a business trust other than a unit allotted by the trust in exchange of shares of a special purpose vehicle as transferred to in section 47, it will be also exempted from the tax. But some conditions are to be satisfied there in section 47. The assets transferred should be equity shares of the company, and the other than a unit allotted by the trust in exchange of shares of a special purpose vehicle as referred to in section 47 is must. Then tax planning in relation to the capital gain. While setting off the loss arised from the short-term capital loss or whether it is a long-term capital loss, how we have to set off while calculating the income tax calculation. In case any loss arised from short-term capital loss, means it is the set off either from short-term or from long-term capital gain. But in case long-term capital loss arised, means it can be set off only from long-term capital gain. It is not to be set off from short-term capital gain. In case the capital losses are not to be set off of the financial year, then that loss to be carried forward for a maximum of 8 assessment years. In case the short-term capital assets being a equity shares in a company or units of equity-oriented funds means the transaction is covered under Security Transaction Act. The tax on gain from such transactions shall be calculated in the some following manner we have to follow. That is the rate of tax on gain from short-term capital assets being equity shares in a company or the unity of equity oriented funds where transaction is covered under the Security Transaction Act shall be a 15% of such gain will be considered. The long-term capital gain means the tax on long-term capital gain is to be charged at 20% in the hands of all the persons. So no deductions are allowed under the section 80C to 80E in respect of long-term capital gain also. I hope you all understand the basic concepts of capital gain and how we would calculate the short-term capital gain and long-term capital gain. What are all the exemptions are allowed by an SSC while calculating the taxable capital gains in Income Tax Act. Thank you so much. We will meet in another video.